have Ryan Smith here with us tonight, and he is going to be diving deep into self storage and manufactured homes and several other topics for you guys as well tonight. So, before we get into the main presentation, I do just want to take a couple of minutes and kind of walk you guys through a little bit about what we do at Quest and how we can be of value to you. But if you've been watching our webinars and you've definitely seen those first few intro slides before, I have actually switched them up tonight. We have a lot of great events coming up for this spring, and we also have a couple of promotions going on as well. So that's what I'm really going to focus in on tonight. But just be aware that Quest does have a lot of other educational resources for you guys, and definitely don't hesitate to reach out to an IRA specialist if you have any questions about how investing with a self-directed IRA works. So for those of you guys who don't know me, my name is Haley Gant. I'm one of our certified IRA specialists here at Quest, and I basically work in our business development and our marketing department. So I work with our marketing team to help to put on all of these events for you guys and bring in all of these awesome guest speakers like Ryan here tonight. But at Quest, at our core, we are a self directed IRA custodian. So we basically teach investors how to utilize those old 401ks or IRAs to invest into things outside of the stock market. So 98% of Americans only have their retirement funds invested into publicly traded assets, things like stocks, mutual funds, CDs, things of that nature. Where at Quest, we teach our clients how to truly diversify their retirement portfolios by investing into things like real estate, promissory notes, and private placement investments. And it's really cool because whenever you hold these investments in an IRA, these investments are sheltered from your own income taxes and capital gains taxes. So it's a great way to kind of diversify that retirement portfolio. And along with that, we like to offer a lot of education about the various different types of investments that you can hold in an IRA as well. We're a pretty good sized company. We are based out of Texas. I'm actually based in Houston. I work in our corporate office, but we have clients all across the nation. We operate in all 50 states, and we have about $2 billion in assets under management. So, all of that $2 billion in assets under management is all alternative, privately held assets that our clients choose to hold in their IRA accounts. You will see a lot of us at Quest that have the certification of a CISP or a Certified IRA Services Professional. So basically, in order to achieve that designation, you have to have worked at an IRA company for at least 2 years and then pass a couple-hour-long exam hosted by the American Banking Association. So a lot of our staff has been with Quest for several years. You'll kind of see as you talk to us that we are really passionate about what we do here at Quest and helping our clients kind of just think a little bit differently in how they save for their retirement. Now, really important here, quick disclaimer, Quest does not provide tax, legal, or investment advice. This webinar, as well as every other webinar that we host, is strictly for educational purposes only. We're not here to tell you how to structure your investment. We cannot provide you with deals. We can provide you with a lot of education and guidance to resources and things like that. But please, please always do your own due diligence before getting into investments. So yeah, please keep that in mind. Standard disclaimer there. And that's actually all I have for my quick slides about Quest. The next ones I have is I really want to focus in on our upcoming educational opportunities that we have for investors out there. Now, I know we are kind of slowly getting back to the live events. Recently at Quest, there's been talks where we are actually going to start getting to attend events sometime soon. So in the meantime, we do still have a lot of great online resources for you. And this is great because you can access this information even if you're not local to us here in Texas. So you will notice that I do actually have Kurt Power online moderating with us here tonight. Kurt is one of our IRA specialists that specializes in onboarding new clients and kind of going through those one-on-one consultations with anyone who may be interested. Along with that, we have a great YouTube channel that Kurt will actually be linking in the chat here. And be sure to check that out. We have put a lot of time and effort into growing our YouTube this year. There's a ton of great videos there. And you can actually rewatch this webinar as well as all of our other weekly classes that we host right there on our YouTube channel. So that's a great resource there. I would definitely recommend that you guys check that out. We have other weekly classes. We have a full education center on our website. But the other event that I want to touch on in this slide here is our virtual networking happy hours. So these events are awesome. They have really taken off since we started hosting them in August of last year. But this is exactly what it sounds like. It's a Zoom meeting. Everyone gets to share their cameras. Everyone gets a chance to introduce themselves to the group. And we basically all kind of have a beer, have a glass of wine together, and you get to meet about 50 to 70 other investors from all across the US. And it's a great place to kind of start new conversations with new people, potentially find deals, potentially, find people to link up with. So those virtual happy hours are a lot of fun. They are on the first and third Wednesday of every month, and I host them myself. So be sure to join us. They're a lot of fun there, and you get to meet some great people as well. Now, just a couple of more events for you guys. We have a lot coming up this spring, so I really wanted to take a minute to focus in on this tonight. But if you are a real estate agent in the state of Texas, we have a CE course coming up on February 18th. You can register for this course through this QR code right here. If you're quick, whip out your phone, pull out your camera. You can scan this and register really easy in about 10 seconds. But this is a deep dive 3-hour course into all things self directed IRAs, both for your retirement and how to take a good base knowledge of self-directed IRAs and use that to help you grow your real estate business as a real estate agent. So it's a free course. You'll get 3 CE credits. And if you didn't get a chance to scan that QR code, just head on over to our website there. Our other big event that we have coming up this spring is QuestCon Live Private Lending Edition. So in the spirit of hosting all events online, Quest has actually started to host QuestCon Live. It is a completely online 2-day self-directed IRA conference. We bring out about 20 different guest speakers from all across the US. And since this is a bit of a larger scale production, this is a paid event. Tickets are in pre-sale right now. It's $50 or $69 if you would like a copy of the event access plus the recording. So be sure to check that out. Ticket prices do go up on March 15th. So don't say I didn't warn you. I will gladly charge you a little bit extra to attend that event. But QuestCon Live is one of our biggest, most popular online events. And the value that you get from the speaker panels is extremely valuable. So reach out to us. If you have questions, our team of IRA specialists, both myself, Kurt, and about 10 other of us, we work very hard to make sure that our standard of customer service and education that we provide to our clients stays very strong. In that, we are very easy to get a hold of. You can chat live with us directly through our website during our business hours. Give us a call, send us an email, or again, in the spirit of the trends these days, we've got QR codes for everything now. You can set up a free consultation with one of our IRA specialists. If that's not incentive enough, if you already don't want to talk to us, we are doing Quest Cares again this month. So we ran this promotion last year and it was very popular. But in the spirit of giving back, we are actually donating 25% of your account opening fee if you open up your account in the month of February. And also, this has been a really big project of mine so far this year. We have completely revamped our referral program. So if you're a Quest client and you've got people in your network or in your friend group that also could benefit from having a Quest account, be sure to use the promo code referral on their application. Have them put your name down, say that they referred you, and they will get a $25 credit to their account, and you will also get a $25 credit as well. So there's no limit to the amount of people that you refer over to Quest. It's a great way for you to refer people to us to give a little bit back to both of you. And I hope you guys take advantage of all of that. So that's pretty much all that I've got. I know we've got a lot of events coming up. I hope some of that stuck. Be sure to join us for QuestCon. Check out our virtual happy hours. But that is all that I have for you guys, at least for right now. without further ado, I would like to pass it on to Ryan Smith. Ryan has a great presentation planned for us tonight. And Ryan, I'll let you go ahead and introduce yourself from here. I'll come back on at the end for some Q&A. And Ryan, I'm excited to see what you brought for us tonight.
Thanks a lot, Haley. I appreciate it. And thanks everybody for joining us tonight. I know it could be late if you're on the East Coast, but I appreciate you being here. So I actually see quite a few names that I recognize. So good to see so many familiar names that I have associated with faces, having met many of you before. So I think real quick, I'm gonna share my screen so you can see, and then we'll get going. Okay, so hopefully at this point you can see my screen, a picture of a storage facility there. So I was telling Haley as we were kind of getting set up just before the kind of the top of the call that when Quest had reached out to do this call, they had asked for some suggested topics that I thought I could contribute value around, and so I sent a list of I think 5 or 6 different topics, and I love the dream big nature of Quest, and I sincerely mean that. So when they scheduled this webinar, they actually, rather than picking 1 or 2 of the topics that I thought we could talk around, they actually sent out all of them. So I say that to tell you we've got a lot of content for you. My hope is that this will be one of the more informative webinars you've ever attended. And if you think so, don't hesitate to let them know that you enjoyed it. But I just tell you that because we are, rather than culling the list and maybe picking 1 or 2 or kind of just tree topping the concepts, I thought, hey, why not? If you're here, I'm here. Let's do the best we can. And so long story short, I think you will enjoy what we're going to go through. So just a little bit about me. My name's Ryan Smith. I'm married to Jamie Smith, my bride. We've got 4 kids, ages 8, 6, 4, and 2. If you want to know anything about my wife and her giftedness, all 4 were born the same week, 2 years apart. So she's incredibly diligent and incredibly administratively gifted. So anyway, father 4, married to Jamie. Here's a picture of my brood at a dude ranch that we go to every summer in Colorado. My son there in the glasses on the fence was less than thrilled with the photo op. He'd rather be riding a horse. So anyway, that's a little bit about me and my family. We live in Orlando, Florida, and we own property all over the place. So I'm a co-manager. My wife and I co-manage now 8 funds. Our focus has been largely self-storage and manufactured housing communities. So anytime you see MHC, that just stands for manufactured housing communities, which at the end of the day is just a fancy way of saying mobile home parks. It's pretty much the same thing. In total, we have acquired, our portfolio, we currently have more than 20,000 units in ownership in more than 25 states. So we've done this for quite some time, and it's a lot of fun. We love storage, we love mobile home parks, and hopefully you'll see why through this discussion. So we do operate under 2 brands. Haley did mention she's the corporate office for Quest is in Houston. Well, we actually own a number of properties in Houston and Dallas and Austin and like I said, about 24 other states. But our brand for storage is Mini U Storage. So if you ever see Mini U Storage, that's our brand. We do not third-party manage for anybody, so that's kind of who we are. And then on the mobile home park side of things, JRB Communities, which stands the initials of the 3 principals, Jamie, Ryan, and Brian. And the short reason there is our brand promises, if we wouldn't live there, we won't let you. So that's kind of our brand there. So the outline for the call that we have here, I thought we'd go, give you a brief background on mobile home parks and self-storage, just briefly per each asset class, why we like to own them together in the same vehicle, there are similarities between the 2, but there's differences that are additive one to the other. Talk briefly about COVID impacts. There's a lot of questions we get about COVID, how's manufactured housing performed, how self-storage performed. And so I'll give you kind of a real picture into how the asset classes have performed. And in short story, they've done quite well. One topic that's pretty, I get asked questions a lot today is, do kiosk-based, self-storage management systems make sense? Do they work? Are they viable? So we'll briefly talk through that. Is there any opportunity left in the manufactured housing or self-storage space? We'll talk through that. And then 5, I'll try to give you 5 ways to add value to mobile home parks and or self-storage facilities. And not as this is probably an unfair tease, and I apologize for doing it, but just it's an interesting discussion I think we'll have time for at the end, where what I want to do is lay down a base of education that many of you probably already have, but then I want to go and maybe use it in a way that's maybe a different way of looking at things. We generally receive comments that we look at things differently and sometimes take a different approach. So one thing I want to do at the end is show you how, if let's say your goal, and it probably isn't, maybe more or less than this, but if your goal is to create $10 million of net worth for yourself, I'm going to break it down into really specific increments on how you might be able to do that. And of course, if your goal is less or more, or if it's not to accumulate wealth at all and be purely charitable, or the point being is we're going to have that discussion at the end, and I hope you find it valuable. So with all that being said, that's what we're going to cover. We're going to get right to it. So I'm going to start with why, in no particular order, why mobile home parks, why manufactured housing communities. So first, constrained supply. So when I got into the mobile home park business about 17 years ago, I was investing my own capital for my own benefit. I wasn't managing funds and buying and working on behalf of other people. I was doing it for myself. First, I had started a software company and made a decent amount of money, and my wife and I set out to deploy our own capital. One of the first things that really jumped out about mobile home parks to me was the fact that, said simply, I saw a moat hiding in plain sight. And what I mean by a moat is a barrier to entry, a differentiating feature, a unique quality to the asset class that I thought would protect my capital from competition, which from other people who would seek to take it. And that unique quality was the fact and the reality that, simply put, mobile home parks are needed everywhere. They're not allowed anywhere because they're generally hated everywhere. And I know hated's a strong word, and you may say, well, I don't hate mobile home parks, and that may be very well and true, but I think I would be 100% accurate if I were to say, okay, everybody on this call today, let's say you like mobile home parks. Let's find let's find a piece of land close to your home and build one. Okay, most people would say, well, you've gone a little too far by getting that close, to where I live. I'm not opposed to the concept, but couldn't you do it somewhere else? And so the short story here is there has been a pretty sizable constraint and barrier to new supply that is in part created by the stigma that the asset class holds. Now, we don't own, we don't seek to buy, we do not own the type of mobile home parks that people think of when you think of mobile home park. In fact, in the background here, you'll see, probably looping at some point, some of the mobile home parks we have purchased at least recently. And I think you would remark that they're surprisingly nice. But the short story is there's a barrier to supply because there's a stigma around the asset class. One additional comment about the barrier, it's not just a motive or the fact that people generally do not want mobile home parks to be built near their homes. It's also not tax efficient. The highest and best use for land is generally not a mobile home park. So there are tax-based reasons, there's emotive-based reasons, but the net effect of all of that is there's a constrained supply. And to demonstrate this with a few numbers, there's about 55,000 mobile home parks in the United States. In the average year, there's about 10 new mobile home parks developed, and there's about 150 that are torn down for highest and best use. And so our thesis long ago when we got into the mobile home park business was that demand, fortunately or unfortunately, right? I mean, there's a duality to that, but we thought demand for affordable housing would continue to grow, and it has. And we thought supply would be constrained by the stigma, and it has. And we think that'll persist from here forward. So we've been right for the last 17 years on those facts, and we think we will continue to be right there. So they're growing demand, they're cash flowing, they can be purchased in a way that produces cash flow. I'm sure there are ways to maybe intentionally or unintentionally mess that up, but they are thought of as being cash flowing assets, which we like. They have low operating expense ratios. Generally, mobile home parks, the ratio may be 30%, kind of on the extreme low, to maybe closer to 50% on the high side. And one of the factors in determining whether you're 30 or 50 is whether or not you own the mobile homes. One feature of the business that you kind of want to decide on early on is, do you want to own mobile homes or not? And I think you could probably assume which way we go with it. And the answer is we do not want to own the mobile homes. We want to own the land and not the homes. Many reasons for this. Lower expense ratio, there's lower replacement costs on the homes, more pride of ownership. You get better quality, residents in your communities, and there's a lot of feature benefits to that. And then mobile home parks actually have significantly long-term tenancies. The average homeowner who owns their home and rents the land stays for typically more than 7 years. But the average home typically stays for as much as 25 years. When a mobile home moves in, it generally is not going to move out, because despite the name mobile home, it's actually not that mobile. And the reason they're not that mobile is they're incredibly expensive to move, generally costing as much as $10,000 plus or minus, depending on how far and who's moving and what state you're in. So those are some high points on mobile home parks. I'm going to kind of leverage some of that for self-storage. Why do we like self-storage? So quickly put, there's an incredibly broad adoption. About 1 in 10 Americans are currently users of self-storage. And one of the tailwinds to the asset class is about 30% of millennials use self-storage. So if 10% of Americans use self-storage and about 30% of millennials are using self-storage, as we get younger and younger, we're seeing higher and higher rates of adoption, which is, a tailwind for the industry. You also have baby boomers retiring and going to smaller format homes. You have COVID, which a lot of people are getting more utility out of their homes. They're having to school their kids in their spare bedroom. They're having to, work out now in their garage because their gym is shut down. So we're having to get a lot more use out of our homes. So a lot of the stuff, a lot of those rooms where the stuff goes are now needing to be used for other purposes. So there's a lot of tailwind that we see in the self-storage space for the long run. Again, cash flowing assets, they're fairly easy to maintain. If somebody leaves, it's as simple as sweeping it out. It's not too hard. No tenants, no toilets. In terms of average tenancy, this is surprising to many people, I think. And this is our average tenancy. So just to make that known, this is for a prior pool of assets that we built a couple of years ago. The average tenancy for that pool is about 1,100 days currently, which is higher than the industry average. And there's a whole discussion we could have maybe at another time on what we do and how we approach that, and how what are some things we do that produce that as an outcome. But that's almost 3 years is the average tenancy for storage, which is quite a long time. So it's a durable, or also known as a sticky tenant, which we like. And also low operating expense ratios. They can, your operating expense ratio in storage could be in the as low as 25% and as high as 40%. Again, depending on how you operate and what your management structure is. So why own them together? So I'm going to go kind of move to the second question. Why put them together? And so I'm going to use this chart to kind of talk through and evidence this. Said simply, mobile home parks and self-storage are similar in a lot of ways, but they're different in ways that I think are complementary and to a degree add value one to the other. So I'm going to make real quick work of this because I could talk for probably 45 minutes on just this chart. But what you're looking at is you're looking at a chart that tracks the net operating income growth, the NOI growth, on a same store basis for every asset class shown over time. So what it does is it basically says, okay, industrial, shopping center, office, mall, multifamily, self-storage, manufactured housing. Everybody start on the same starting line, puts everybody on the starting line, which is $100 per store. Okay. And it's 3, 2, 1, go and grow. And then it tracks the growth over time. Everybody's starting from the same starting point. And so the two best performing asset classes, and by the way, this is from City Investment Research from March of 2020. So this is third-party data, and there's a lot of places you can get it. But what you'll see is the two best performing asset classes over time over the last 20 years, this is from 2000 to 2020, has been self-storage and manufactured housing, or I should say manufactured housing and then self-storage. Okay, now, why is this chart? What does this mean? Why is it important? Well, if we're all buying, if everybody here is buying a storage facility or a mobile home park, okay, I suspect that one of the attributes of the investment that you might be targeting is some element of cash flow or income. Now, as we look to the future of ownership with this asset, okay, not only the asset, but the asset class, what expectation would we hope to achieve over the long term with this asset? Well, we would like the income to ideally over time grow. No guarantee that that'll happen, but we would like at least the prospect of that. So one of the things I like about mobile home parks, as it says here, manufactured housing and self-storage, is historically, and again, no guarantee of future outcomes, but historically, they've been number one and number two performers. The irony is, and I'll mention something that's not shown here, but the average growth rate, the average NOI growth rate over the last 20 years for both asset classes is roughly 4.3% for both. Okay, so, and that's sourced from NAR REIT. If you want to go to NAR REIT, they have tons of data, and that figure is sourced from NAR REIT. But the point in it is manufactured housing and self-storage have grown at an average rate of 4.3% per year. And you can see there's no close second. I mean, multifamily is third, but it's not close. It's a distant third. So some of the aspects I like. So number one, you can clearly see here that over time, manufactured housing kind of overtakes self-storage. And then at other times, self-storage really closes the gap, catches up, takes a lead, and then vice versa. So what you'll find if you look at the data is manufactured housing historically has been more, I would say, more consistent in terms of its growth rate. Its rise over run has been a little bit more stable. And I don't want to say predictable as if it'll never vary, but it has been historically a little bit more predictable than self-storage, which has been, the word I would use is a little bit more elastic. So I use elastic because you can kind of see as a rubber band when things go flat. So if you look at 2008 to 2010, self-storage generally was flat in terms of NOI growth. But you can see really starting in 2010 and on, not only did it shoot out of the hole, it caught up quick and took the lead, which is what I mean by elastic. So when you look back historically, if I can say, okay, you can go back to 2008 based on the facts of today, go back then and choose an asset class, I think many people would probably choose mobile home parks in the 2008 to 2010 Great Recession. We owned them then and they did quite well. Now, if you were then to say, okay, 2010 to 2019, which one would you pick? You actually would probably pick self-storage. Now, if it's back to 2019 to present, you're back to mobile home park. So we like buying both within the same vehicle because we believe it offers some stability, the manufactured housing component, with the elasticity of self-storage that we also like, and the fact that when it runs, it really runs. Now, I'll make a quick point as to why, if you're curious. So if self-storage, let's say the market allows me to raise my rental rate by 15% next year. I'm not saying it will, just a hypothetical. Let's say that it does. If I'm able to raise my rents by 15%, it's self-storage. Nobody really cares. Most people say, well, good for you. They're hoarders anyway. I don't mind, which by the way, they're not. But this is the mindset of the market. It doesn't really matter. It's a storage, tenant and, que sera, sera. But if I were to raise my rents on a mobile home park by 15%, or more, a lot of people would not like that because now it's, housing and it's a different aspect. So that's one of the reasons for the fact of self-storage having more elasticity than manufactured housing. But we like both for the reasons described and more. I'm just trying to pick a couple. Now, historically, if you look back, this is from Green Street Advisors. This is dated 2018. And it is that data is somewhat dated to that effect, but it is the most current that I could find that shows it this way. So I just disclaim that, and you can see if you can find a more current version of this. But it's interesting, at least as of 2018, the trailing 10-year total return, number one was manufactured housing, number two was self-storage, and then freestanding, basically single-family residential, then apartments and lodging. But there's this statement that you'll hear from time to time where people will say, the greater the return, the greater the risk. Things are symmetric. And that's kind of, if you've ever read A Random Walk Down Wall Street by Malkiel, he asserts that markets are absolutely efficient and the return you are receiving is commensurate with the reward. And Buffett, by the way, rebutted that book in that statement in a nursery rhyme. He did it in a children's story, which was quite funny if you want to look that up sometime. But in short here for time, the right-hand column says sector risk, beta with REIT index. So what beta is something called correlation, meaning it's basically, it can be thought of as to some degree as how correlated is the investment to the broader market, basically. Now, if you have a correlation of 2, that means a correlation of 1 means you're highly correlated to the market. If the market goes up $1, stock market goes up $1, your investment goes up. If it goes down, you go down. So what you can see here is manufactured housing, it says, has one of the lowest, actually in this chart, the lowest beta rating, and self-storage has the 3rd lowest beta rating. So it has the top 2 highest total returns on a trailing 10-year basis, but out of the bottom 3 for beta or correlation to the market, it has low market correlation, which is there's an asymmetric correlation there, which we like. So moving on to COVID, how are we doing with COVID? By the way, I'm going to take a quick breather, let you take a quick breather. I hope you're enjoying this. Like I said, we've got a lot to cover and we're almost halfway through. So if you do have questions, feel free. I'm not going anywhere. In the interface, feel free to type them in. If you have something that I said triggers a question, feel free to ask and I will do my best to answer. So in terms of COVID, so just quickly where this information I'm going to show you is coming from, I thought I could do a couple of things. I could give you kind of third-party data, but I thought since we have some asset, obviously quite a few assets that we own and operate, I just take some data from what we've seen kind of firsthand on the ground. So this data I'm going to show you is from our 7th pool of assets. We call it Fund 7. And Fund 7 is not open for investment, but it is. It'll at least allow me to speak to this. So it's also same store figures, and you can kind of see the disclaimers at the bottom there. But in terms of this data for Fund 7, self-storage occupancy on a year-over-year basis was 90% at the time. This is as of the end of July. So we did July of 2019 to July 2020 for both manufactured for self-storage and the other. So the storage revenue storage occupancy was 90%, and it was up 6 percentage points from 2019. So occupancy was up, revenue was up 3% in terms of collected revenue. And there's a reason why I want to show both revenue and occupancy, because there could exist, in some cases you can claim occupancy, but it's shadow inventory, it's shadow occupancy that's not producing income. So revenue's up, occupancy was up. Manufactured housing community occupancy was 91%, which was up year over year, and revenue was up, roughly 10% in terms of collected revenue. So we've seen some impacts, some specific impacts between April and May. When COVID really was flaring up, we saw a decline in foot traffic in our storage facilities. But on the whole, through the year, things did quite well. We finished up occupancy and revenue wise. And we think the asset classes will do quite well in the long run. Now I'm going to move real quick to do kiosk. I can say that word, I promise. Do kiosk-based management systems make sense? And let me first describe what I mean. And I think you know what I mean, maybe. But there's this approach that started showing itself really around 2013. And what it was is, you buy a storage facility, you get rid of the managers, you don't have any real human labor on site, and you put up giant, kiosk terminals that people can come, they can browse your inventory, they can rent a unit, they can, gain access to the facility, and it's kind of all automated is kind of the promise. So it's the promise is it's a tech-enabled, management system, which, I didn't go into my background, but I started a software company when I was a teenager that was the basis for my beginning in real estate, deploying my capital for myself. So that came from a software company I'd started. So I like technology, I like software. I get the promise of what they're trying to do, but ultimately it's not something that we find all that compelling for very specific reasons. Now, what I'm not saying here is that there will never be in the future a system that would maybe reduce some of the friction of current systems. There could be some systems in the future that work quite well. We just do not think the technology is there quite yet with regards to offering a really smooth experience to the customer. So number one, many of the kiosks that you'll find are actually manned. So it's not like they're completely unmanned. It's just you can go up and you can touch the buttons and get a unit. But if you need help, there's still somebody there on site as kind of a fallback plan for the property. So it's not as if those are completely unmanned. The terminals, the hardware, the software, the ongoing fees, the support do add cost. It's not like those are free or cheap. And they're only as good as the data feed. If somebody walks up and rents a unit, you want to be competitive with the market. You don't want to underprice. You don't want to overprice, as that may either one, you're losing revenue, or two, you're sending somebody down the street. And so your experience or the net effect and the benefit to you as the owner, you're really only as good as the data feed. And then there's a cost to that. And the other issue with that is, like, for our stores that we have nationally, we do not produce our data as public information and throw it into national feeds. So it still would require, in order to really find out what your local stores and your competitors are doing, it still would require you to have human labor as part of the process. And the other part I should mention is, automation. It's not like a kiosk is the only way to automate. So for us, you can go online to our website, pick a location that's convenient to you, find a unit that fits your needs. You can rent it online. You can do the paperwork online. You can download the app on your phone, and you can gain access to the gate code. And you basically take your app, click a button when you go up to the gate opens, touchless process. So a lot of automation and technology can be accomplished via website and mobile apps as an addition to the human component. And I'll lastly just mention this. Our way of managing is, we want to give, number one, we want to provide every property we have a standard called Disneyland Clean. Every mobile home parks and self-storage, Disneyland Clean is our communicated brand standard. We want you to remark at how clean it is. I can give you a quick example of this. I was at one of our storage facilities out in California recently, and we constantly are in the field walking properties with our managers, and so we do something called walk and talk. So if people are in the industry looking to make investments in the industry, want to know more, want to meet us, then they're welcome in any one of our property tours. They can come with us and walk, and we have conversations. And what is that? And why do you do this? And anyway, we had about 20 people walking into the office of one of our storage facilities, and we got inside, and the manager, a guy named Steve, who's been with us for quite some time, commented, and he said, I'm so sorry about the leaf. There was a maple leaf in the drive, in the parking. There was a handicapped parking spot right out front of the office, and he was really bothered by the leaf, big maple leaf, and the reason he was bothered is we have a brand standard that's Disneyland Clean. It was fall at this time, it was a couple months back, and he was bothered because he had blown off all the leaves. It was nice, and then we got there and there was a leaf that had fallen, and he didn't want us to think that he had missed the leaf. And that the point is, do we care about the leaf? No, it's a leaf. Leaves fall from trees. That's that's perfectly reasonable. But what we loved is the fact that he cared about the leaf, and it bothered him so much. And by the way, the leaf was gone shortly thereafter. But the point is, that's not an experience. That's not a quality that can be produced with a kiosk. Number two, we use merchandise as a relationship tool. If you've ever been into a storage facility, you see all the bubble wrap and the locks and the different things. We commonly will see people try to store their stuff with a lock that's inferior. And we'll say, listen, we don't feel comfortable with you using that lock for your benefit. Take any one of our locks, you can have it, it's on us. So we try to use merchandise as a tool for relationship, which is, this is a eye-rolling statement, but we value relationship. Our business is incredibly relational. Although sometimes finance may not seem like it, it is. It all, people matter at all ends of the spectrum. And so in terms of the human component, you really couldn't accomplish that, we don't think, well with a kiosk. Number three, when you go through the gate and you access your unit as a customer of ours, our manager or managers will get in the golf cart that every site has, and they'll drive to your unit and bring you ice cold bottles of water as just to make sure that you're doing well. And it's a free look into what you're doing to make sure that people are doing what they should be, but it's also bearing gifts. It's a good experience, and so you couldn't do that with a kiosk. And lastly, I think we've all been in a grocery store with a manned, with a station where you go in and you scan this and that, and there's that one item that will not scan. You're doing it right. The machine's not working. It's driving you nuts. Now, what would really make you probably, lose it is if there was nobody anywhere that could help you, and you're pushing the buttons, you're doing this, and nothing's working, and there's nobody to help you. So again, we think the human labor, our team, our people offer a superior experience, and we don't expect that to change in the short run. So those are some high points. Now, is there any opportunity left? We think there's quite a bit. It depends on kind of what your model is, on what you're trying to do. If your goal is to buy, let's say if your goal is today to buy $1 for 50 cents, there may be opportunities every now and then, but our focus is to take $1 and make it worth $2 in the long run by adding value to the dollar. Now, to the extent that I can buy it for 95 cents or 90 cents or 85 cents or anything less than $1, that's great. But with our model and our way of looking at things, I guess that we think there's a lot of value left. I'm just going to show you beyond that statement. Although I did say, try to keep it simple. Is there opportunity left? We think so. Here's some data that also kind of supports that. This is again from Green Street, who, if you're not familiar with Green Street, I like them a lot. They have a lot of great data, and a lot of their reports you can download for free, and they have subscriptions as well. But a point being is here, what this is showing is kind of the expected property level returns on a risk adjusted basis in the future, in the long run. And so number one is manufactured housing, and then you can see self-storage in that blue bar. This is a storage report, so you can see that blue bar, storage. So the projection for the asset classes, both manufactured housing and self-storage on a risk adjusted basis, are fairly strong for the long run, and especially if you blend them out like I've already talked about. So 5 ways really quick to add value to mobile home parks and self-storage. Now, what I want to do really quickly here, just to, again, kind of briefly pause, because what we're going to go through here, I think, is incredibly important. This is something that is surprisingly simple, but I have found not a lot of people truly understand what we're going to go through. So I think it's probably one of the more valuable things I can relay to you on this call or any other call. So I'm trying to put my best foot forward with you guys and give you as the best that I got. So this is something that I think is important. So 5 ways to add value. Before we go into those 5 ways, the concept of those 5 ways are, to a degree, less important than understanding the basis for which those 5 things are built on, or the foundation for which those 5 things are built on. So it starts with a statement, and I'll make a couple of comments kind of saying the same thing in different ways. Number one, I think there's a lot of people who do not understand the value of $1. And it's not the statement that you hear necessarily from from other people. Let me give you an example of this. Now, if we were all, I have 4 kids, and many of you have children. If you were to go to a parking lot of a Walmart tomorrow and just pull up and say, okay, kids, let's get out. Okay, go find $1. We can go home as soon as you find $1 in aggregate laying in the parking lot. Okay, you'll get eye rolls, you'll get complaints. It's going to take a long time. It's hot, it's cold, it's always something. But the point is, they will not like that experience. Now, what happens if you told them, listen, you go find me $1 and bring it back, and I'll hand you $240 for every dollar you find. Now, you may find them more enthusiastic because there's something about this dollar that's unique. They know the value of it, or I should say the value is far different than just $1, right? It's not just $1, it's $240. Now, a couple of things on what I'm talking about, and if this is new, I'm gonna go through it really quickly. Now, a couple of other comments. One, it's very difficult today to earn yourself rich. Through earnings, through income, through W-2, the way the tax regime is structured, and I'm not your tax counsel, and maybe your tax counsel will say otherwise, but based on my knowledge of the system and my conversations with my counsel, I will say it's heavily slanted against the income you derive from a W-2 paycheck is typically taxed fairly high. And as you make more and more, the tax goes up over time. So we think, it's very difficult to create wealth through earned and saved income. So our focus is not, it's not that income doesn't matter, it's the value of the income, which is important. And this was a shift in my mind that I had in my mid-20s that a friend of mine, 30 years my senior, basically, respectfully smacked me one day and he said, well, what's your goal? And I said, well, I think at the time our goal was to go from wherever we were to 30,000 a month was the goal. And he goes, well, that's fine if, he said something like, well, that's fine if that's what you want. And I said, okay, I'll bite, tell me, what am I doing wrong? And he did. And I was. And so let me walk you through this really quickly, and then we'll kind of build on it. So there's some assumptions in here, and we can, maybe on another time go through a lot more variants of this, but assuming a property is valued at a 5% capitalization rate. If you're not familiar with capitalization rate, or for short cap rate, there's a lot of ways you can think of cap rate. If you're familiar with stocks, in some ways it's like a PE multiple. Like you have earnings and you have the PE to get to the stock price. In real estate, it's kind of the same way. You have NOI, and then you have the cap rate applied to get to the value of that NOI. So it's kind of a multiple in a sense in that way. But let's just assume that a property trades at 5% cap rate. Okay, could be 6, it could be 7, it could be 10, it could be whatever the situation calls for. But let's assume 5. Now let's also assume. So if we all bought a property, okay, tomorrow we're all buying it. We're buying it together. Okay, what do we want to do? We want to ideally find ways to make that property more profitable on a net basis, right? We want to net more every month. Now we can do that by adding line items of revenue, by pushing rents, by cutting expenses. We can do a lot of different things. But let's just say we found a way to add $1 a month of NOI to that property. Now, how likely do you think that is that we all can put our heads together and come up with a way to do that? And I think you would all say, yeah, we can do that. So $1 per month, okay, 12 months in a year is $12. Now take the $12 annual, divide it by 0.05, which is the 5% cap rate, and you get to $240. Okay, so that dollar a month that we found is worth $240, meaning I could then sell that property for $240 more than I bought it for, and somebody would pay because that's the multiple on the cash flow. Okay, that's I can go, but the point in it is we have every $1 a month at a 5 cap is $240 of value. Okay, now I want to make one other point here. We manage our own assets. We think management is incredibly important. Okay, and let me tell you why and maybe describe why. Now, using this example, and this may muddy the water with you, and I hope it doesn't, but I think this is important to conceptually understand. So let's say we have a 50% expense ratio. Okay, just another assumption I'm adding here. So let's say the property, we bought a property, and tomorrow we find a way to add $2 of gross revenue per month 50% is expense, which leaves $1 a month net. Back to our example. Okay. Now, property managers. Let's say we hire a third-party management company. And let's say we pay them 5% to manage the property. And maybe it's 6 or 8 or 10, depending on the property type, the size. We manage for 5%, which is why I'm picking 5%. But let's say it's 5%. So if you have $2 a month of revenue, right? We're adding $2 a month of revenue. 5% of $2 is 10 cents, is it not? So if you have 10 cents for producing $2, so you're paying another party 10 cents to manage $2 of revenue, that at a 50% expense ratio is $1, capitalized out is worth $2.40. So the question I have is, who's going to be focused on adding more dollars in the future? The person who gets $240 for every dollar found, or the person who gets 10 cents for every dollar found? Which person cares a lot more about those dollars? And I would at least posit that I care significantly more than anybody else, because I know the value of the dollar, and I would rather cover my cost at 10 cents to manage so I can focus on creating $240 dollars, if that makes sense. So this is why we manage ourselves, and we do not run to third-party managers to do the work, because we don't think anybody else will care as much as we do, because again, it's 10 cents versus $240. Now, there's other things we can go in. I'll make one other quick point. I hear a lot of people who say, well, I really want to buy 10 cap assets. Okay, it's kind of become somewhat of a unicorn in to a degree cash flow circles. There's a whole discussion here. I understand why people are doing it that way. We have a different way of looking at the world, but let's then put in 10% cap rate here based on your model. For every dollar a month you add to your property, it may produce a little more cash flow, which is taxed at a higher rate, because that's where income is taxed. Wealth historically is not. And for every dollar a month times 12, you get $12 a year divided by 0.1, which is your 10% cap rate. Your dollar is worth 120. So a 10 cap dollar is worth 120. A 5 cap dollar is worth 240. So in that sense, my dollar could be worth twice as much as your dollar. So there's a big discussion here. I'm literally just kind of tiptoeing around the edge of a really fun conversation. I hope you see it that way. I hope you're like, well, I could see that would be fun. Some of you at this point may not be agreeing with that statement, but believe it or not, it's actually a fun conversation. Okay, so let's build on this kind of base. So 5 strategies that you can use. So obviously, if we buy a mobile home park, like any of the properties that are being shown down here or back here, we can, if we, let's say, buy a mobile home park and it's 100 spaces, okay, 100 pads, let's say 99 are occupied, we own none of the homes, and there's 1 that's vacant. Okay, so let's say that 1 pad is $500 a month rent. That's obviously $6,000 a year of gross revenue. And then let's just take $2,000. I'm making assumptions here, but let's say our net operating income is $4,000 a year from filling that pad. So we bring in a home, we sell it to a resident. We no longer own the home, but now we have revenue from that pad. $6,000 gross a year, $4,000, let's say, net a year. And let's say, again, sticking with the 5% cap rate, let's say we can then sell that property for 5% cap rate, at a 5% cap rate. So you take that $4,000 a year of revenue divided by 0.05, which is $80,000 is what you'd come up with. So for every pad in that park that I bring in a home, sell the home, and rent out the land under those assumptions I just gave you, it creates $80,000 of value for me as the owner, which I then can go, if I do that enough times, I can go to a bank, refinance the property, take the equity out of the property, and not pay tax on that equity because it's borrowed. So I have cash flow I'm using to create value, and I'm accessing the value in tax efficient means. So there's a lot of, as George Bush said, strategies that can be employed here. So add revenue opportunities. I'm not going to go through the specifics and do the same NOI. I'm going to move through this, and then I want to finish with one example and then get to your questions. And y'all have been great. So I really appreciate your attendance, and for, again, everybody coming out. I hope as I said at the top, that this is one of the most informative webinars you've been on with Quest or otherwise. And if you think so, please let them know. So ad revenue opportunities. What do I mean by that? When we buy, let me give you an example. When we buy a mobile home park, do you think mobile home residents need storage? And the answer is yes. So we oftentimes will bring in storage opportunities into our mobile home parks, which we're in the storage business as well, separately from mobile home parks. So we know something about storage. So finding ways to add line items of revenue. We also, in the storage business, we may buy a storage facility where, generally speaking, the smaller unit size, if your average unit size is a 5 by 5, we shoot for 10 by 10. We want our average unit size to be a 10 by 10. So said another way, if we're buying 50,000 feet of storage of net rentable square footage in a storage facility, we want that to be about 500 units, which is about 100 on average, right? So if the mix is too small, the average unit is too small, so let's say 50,000 feet has 1,000 units, the rental rate for the smaller units is higher typically than the bigger. But because there's so many small units, it's hard to absorb them and rent them out. So there's a way that we look at it to optimize the unit mix, and that's a way to add value. You can expand. So we are currently, we own a storage facility on Tropicana Boulevard in Las Vegas, Nevada. We bought in the fourth quarter of last year, and we're in the process of tearing down an old car wash that's in the front of the property, right across from an In-N-Out Burger over by Summerlin. And, in short, there's an opportunity to tear down the car wash and build a 3-story, 30,000 square foot building offering then new storage. And that's a way to expand. And then there's ways you can optimize mobile home parks in specific ways that for time, I won't go much into right now. But here's the thing I want to end with. I like, based on what we just spoke about, okay? So we just went through NOI, the value of a dollar being worth, the potential of $240 at a 5% cap rate. So what I want to do is I really want to play around with this. So we kind of laid a foundation. What I want to do is kind of build and kind of end with a thought experiment. So the thing I like about, kind of understanding the component parts is you can take your understanding and move forward with it. Or you can take your understanding, jump to a point in time in the future and work backwards to where you presently are. And you can kind of really play around with that. So I'm going to do the latter because it's the way I like to think about things and back into current action. So a couple of things. Let's say, for example, you have a goal of $10 million more than what you have currently. Okay? So for what it's worth, that may be astounding, meaning far greater than you could ever imagine. It may be far less than you ever hoped for. I know that this audience is probably very diverse and broad in terms of hopes and dreams. And, some of you, may, and I hope many of you have a goal to maybe give and give in ways that are surprising and stark. And anyway, I can go on about that. But the point being is, if you have a goal of, either keeping or giving or both $10 million more than what you have today, let's take what we've talked about and talk about how that might be possible to do that. So again, assuming a 5% cap rate for value, assuming a net worth goal of 10 million, and assuming 1,000 unit goal. And what I mean by 1,000 units, that could be storage units, it could be mobile home lots, it could be, whatever you want. It also doesn't have to be 1,000, it could be 500. You'll see kind of where some of these assumptions come in just a second. So with this base assumption, okay, so here's what we're going to do. So let's say we're going to start with your $10 million goal. So if you have a goal of $10 million at a 5% cap rate, you need 500,000 of net operating income, more than what you have now. And some of you may be thinking, well, that's pretty simple math. That would be 500,000 more is what I need. Okay, it may not be, but the point is, at 5% cap rate, you need $500,000 of NOI more than what you have. And I will be, I think we can all agree it's a big number, hard to wrap your mind around, hard to start nibbling at that. So where do we go from here? Okay, so let's divide that into months, because that 500,000 of NOI is an annual amount. So it's divided into months. I just put approximately here, $40,000, which is the approximation. I know for my my actuaries on the call, you'll start twitching if I didn't have that approximate sign there. But and by the way, I'm like that, so I put that for me as well. But divided into months, let's say that's $40,000 a month. So what you need is you need $40,000 a month, roughly, of NOI per month, more than what you have now, and your net worth would be increased by $10 million. Okay, but still, $40,000 a month. Where do I start? It's a huge number. You get all the kind of all the noise. So let's divide that by 1,000 units, or could be whatever number of units you seek to buy. So let's say it's 1,000 units. So you need $40 a month. You need to, if you owned 1,000 more units than you have now and added $40 of net operating income to each unit, you would be worth $10 million. Okay? But that's still, it's a lot of units, a lot of $40. So let's give yourself 5 years to do this. You don't have to do it, next month, but let's give yourself 5 years. And so you take the $40 divided by 5, that's 8. So summation, if you bought 1,000 units and found a way to add $8 a month of net operating income to each one of those units each year for 5 years, you would be worth $10 million more than you are today. Okay, so wanted to break it down into bite-sized increments to show how possible and doable it is. And so what we are in the business of, my whole business is very simply, a lot of times you hear these big numbers and hundreds of millions of dollars, and my whole business, my whole world is about the value of a dollar, knowing the value of a dollar, and then spending my time trying to find as efficiently as I can, as many dollars as I can for myself and others. That is what we do. We hunt for dollars. And so it's a really fun business in that way. And so, a couple of, I guess, last thing, just for contact, if you want to, I'm going to get to questions here. I just want to say thank you for your attention. I think that's right at about 45 minutes, I believe. I wanted to leave time for Q&A, and I hope there are plenty of questions. But I just want to thank you for your attention. I want to thank you for being here and showing up. There's a lot of other places you could have been. And so I appreciate it, and I hope you found it valuable and at least interesting. If nothing else. So this is my contact information. Feel free to reach out at any time if I can be helpful. And if you ever want to walk and talk at a property, feel free to let me know. So Haley, I'm going to, I think, turn it over to you.
Yes, awesome. Ryan, that was so great. I love how you just put it all into one presentation. And I do have to say, I definitely think we need to bring you back and dive deeper into some of those topics, because you covered a lot of great stuff today. We do have a couple of good questions here. Guys, we may not get to all of the questions, but be sure to take note of Ryan's contact information. He's a wealth of knowledge, as you can tell, but let's go ahead and get some questions answered. So this is a good one from Troy. Troy wants to know, is your company forced to purchase land for new projects in the exurbs due to zoning restrictions in the cities and suburbs? How do grandfathering provisions usually work in the cities and suburbs?
Did he mention by any chance an asset class specifically?
He did not, no.
So I'll take a stab at it and try to answer it. If by the way, if I don't fully answer your question in the way that you intended to ask it, feel free to type clarifying, feel free to clarify and I'll do my best to kind of circle back. But in short, we do not develop mobile home parks. We buy existing because it's very difficult to build them. If you were to develop a mobile home park, in many cases, you'd have to go out, I think to your point, you'd have to go out into unincorporated areas where you're basically putting mobile homes on land. And that's actually not a mobile home park. We want something that is both zoned and permitted as a mobile home park, because once that permit is issued, you are grandfathered in and you can't be kicked out, so to speak. So, but however, it's very difficult to get that permit approval. So a lot of times what people will do is they'll go out to the periphery of town, they'll buy a piece of land, put a bunch of mobile homes on it and consider it a park, but it's actually not a park. And I guess the last part of that is, sounds funny, but one of the points of our diligence in our due diligence is to actually verify that a mobile home park is a mobile home park by permit, not just by mobile homes on land. So I think that's, I'm assuming that was what you're asking, but I may be way off.
Mm-hmm. Yes, yeah. So he was referring to mobile home parks there.
Okay.
Let's see. This is a good question from Jeff. Jeff wants to know how many employees might you require to run a mobile home park, say with 100 units?
So it's kind of circular in that we want to buy mobile home parks in not only quality assets and quality markets, but we want to buy them in a way that we can really run them well. And so when you start getting into the smaller unit sizes, and by that I mean about 50, and there's some subjectivity to this, but let's say let's say you buy 50 units. It's very hard to find quality management because you really you're kind of trying to find hybrid strategies of turning residents into part-time managers, and it's just not, you can cobble together a strategy, but it's not what we want in terms of customer experience. So generally speaking, we want to buy 150 units or more is what we're targeting, is 150 units or more. And that allows us to have a full-time manager. So we usually have a full-time manager, and then we have usually a part-time maintenance individual that'll help for the light stuff, and then for the heavier stuff, we'll bid it out and have third parties come in and do that work.
Awesome. Great answer there. So this is another good question from Curtis. Curtis wants to know about the different type of markets that you invest in. Are migration trends affecting the markets that you guys invest in? Kind of tell us a little bit more about that.
Yeah, so we're really picky on markets. We want to be in primary markets. So we're actively right now we're working to buy a mobile home park in the Washington, D.C. metro, which we like Washington, D.C. because generally speaking, because I don't know any other way around to saying this, but politicians generally do well. They usually don't, Washington, D.C. weathers a lot of downturns fairly well. So we like D.C. a lot. But to your point, you're really speaking to a degree on risk. So there's a number of risks we're cognizant of. Number one, we want to buy where people are moving to and not from in a big way and on a sustained way, not in a short term, like what we would want to avoid. I'll give you an example. Think back in 2013, off of recollection, there's a town called Williston in North Dakota, which was the oil boom, the tent cities and people where everybody was moving. It was like the gold rush for oil. And there was a huge shortage of housing. And people were calling us saying, well, why don't you go to Williston? The population is booming, people are moving in caravans. And our challenge with that was we thought it was more episodic than a long-term trend. And so we didn't go to Williston, and it proved to be a good decision. Now, on the other hand, we think, Austin, Texas, Dallas, Houston, Denver, Florida at large, DC, I can go on, but the point is those kind of markets, we think 20 years from now will continue to be growing. So we want to buy where people are moving to, not from. We're cognizant of acts of God risk, which are, flood, fire, wind, hail. If you want something funny to think about human nature, I've chuckled at this many a time, but if you want to move where there's no acts of God risk, there's also no people there, which is also, it's just funny about something about us, but we are cognizant of acts of God risk. We also have, insurance. We insure every asset, obviously replacement and fire, wind, and all of that, but we also have loss of rents insurance called business continuity coverage, where we cover the asset for at least 1 year of revenue, per a natural disaster. We want to buy where there's low regulatory risk. So in the mobile home park space, that might be rent control, an unfavorable tenant landlord act. There's some states that are better than others. Last one that's somewhat unique that may not be as plainly seen. There's a risk we identified years ago. About I'd say probably 98% of my net worth is in our portfolio. And if you're a financial advisor on this call, you just probably screamed. But the point of me mentioning that is I care a lot about risk, and I'm aligned with caring about it. But we learned years ago about a new risk that was kind of an interesting one where, and it shows itself in the mobile home park space predominantly in some ways in Georgia, Alabama, Louisiana, Mississippi, really Western Tennessee, Arkansas. And it's called what we call stratification risk. And what that means is if I'm buying a mobile home park in Dothan, Alabama, just picking a town. Okay, I want to buy that. I want to own that asset, and I want to have some vision and a degree of likelihood that I can grow that net operating income over a long period of time for the reasons we just talked about. But the challenge in a lot of the areas that I just talked about is you can buy homes in a lot of those areas for $40,000, $50,000, $60,000. So if somebody can buy a single family house with land for $40,000, $50,000, $60,000 and their payments $400, $500, $600 a month, I now owning a mobile home park in that market, I kind of have to wait for single family housing to run and really grow and get out of the way for me to then have some segmentation or some separation or stratification to then be able to move my rents upward. So I'm kind of capped out by other players in the market, and there's not a lot of space. So I want a market with very clear segmentation or stratification, however you want to look at it. Like Austin, a single family house today will cost you around $2,400, $2,500 a month on average. Apartment maybe $2,000 a month, and a mobile home park maybe $600 a month. So huge blue ocean between our product type and any other product type. So that's a risk, and there's others that we consider, but that'll give you kind of some broad points.
That's interesting. That's actually not something I've really thought about before. So, really interesting point there. And so I want to ask this question, but before I ask this question, I want you guys to know, obviously we are not here to pitch investments or anything like that, but I do think that it would be interesting to touch on the structure of how you guys raise capital for this. Do you get a loan? Do you take on equity? Do you raise capital from investors? How do you guys fund these deals as you're going out and doing this every day?
Yeah, so we think of ourselves as conservative, and we're known by others. Kurt, who's on the call, would probably second this, but we're known in the industry as being relatively conservative. So when we buy an asset, we generally go in with 50% loan to cost, which in many cases we can get 70 to 80%, but we choose 50% because we think if we like the asset for the long run and we have a very clear path to adding value and a plan, why complicate things by taking unnecessary risk? And so said another way, and this is a very rough statement, but generally speaking, your break-even occupancy on an asset might be somewhere around 10% more than your leverage rate. So if you're financing 50%, your break-even occupancy might be 60%. If you're getting 80% financing, your break-even occupancy may be somewhere close to 90%. So that's so, for us, it's so much risk. It's not worth it. So for us, we choose 50% leverage. So 50% of our debt is 50% of our capital is debt. The other 50% we raise. And so we have, we've been doing this for a long time. And so we have a lot of friends and family who've told people. And so anyway, we have a great investor community who's participated with us over the last 11 years and continue to. But so we couple the 50% debt with 50% equity, generally at acquisition, and we go in and we acquire the property. And then our strategy is, some 5 years later, plus or minus, we then want to refinance the assets, maybe take the leverage rate up to 60% plus or minus, return, most if not all capital to investors, and then they maintain their ownership in the asset, having then, all or a portion of their capital back. So that's the strategy. I think I did that. I guess the only other thing I would mention that might find interesting on the debt side for mobile home parks, the agencies are very active. The agencies being Fannie Mae and Freddie Mac. So we just rate locked on a property the week before last Friday, and we rate locked. It was 30-year AM, 10-year fixed at 2.77% with 1 year IO, and it's 2.77 fixed with 1 year IO, which is interest only. Late last year, we also closed a loan on another mobile home park we have in Phoenix, Arizona. And that one was, I believe it was 2.53%, 30-year AM, 2.53% with 3 years IO. So very favorable terms on the agency financing today.
Mm-hmm. Nice. That's awesome. That's also good to know. It's crazy how low those rates are right now.
Well, we'll take it.
Yeah, right. All right. So we'll do just a couple more questions here again, guys. If sometimes when the questions get a little lengthy, really specific, reach out to Ryan, have a follow-up conversation. Nice wealth of knowledge there. But we've actually gotten this question from a few people, and that is, what are your thoughts on RV parks or maybe like a mobile home community and RV park combination? What's your opinion there?
So personally, we don't do anything with RV parks because it's a very different model, very different business model, a lot more operational, in nature. You have there's somebody can move out in the middle of the night and not pay. So it also requires a lot more management in terms of marketing and some of those things. On the lending side, generally speaking, if you're buying a mobile home park, if it has more than 10% as RV spaces, it's actually very difficult to finance because they don't really know what to make of it. It's too much. They view a mobile home park lender will view it as too much risk to the RV business, there's far fewer lenders that do RV parks than mobile home parks. So you're kind of muddying your own water there. But I'll say all of this to say I have friends of mine that own RV parks, and they have done quite fine, especially with COVID in mind. I think longer term, it's more of an active business, higher expense ratios, more marketing, a little bit more market risk, and then I also question the liquidity on the back end. There's not a ton of publicly traded companies that are in the RV park business and private equity firms chasing that type of investment. So when you come to potentially liquidate on the back end, you may not command the same cap rate as other asset classes. And going back to the example, what that means is that dollar may not be worth as much compared to other dollars in other asset classes.
Mhm. Awesome. So this next question here is from Christopher, and I like the way he's worded it. I think he might be quoting something you said earlier. He wants to know, so how do you just acquire 1,000 units? Just kind of casually, how do you acquire those?
Christopher, you just do it. It's not you just do it. No, it's a fair question. I think so. I was trying to pick a nice and clean and simple example. There are some ways you can, to a degree, just buy 1,000 units, but one more practical way is, and depending on where you are in life, what you're trying to accomplish, you can buy into portfolios of units with in a passive sense. That are constructed. You could do that, or if you're, I don't even want to say younger because it doesn't have to be younger, but if you're really feeling energized around building your own deal, whatever that is, then you can do it yourself. And it might, you might buy 10 100 unit mobile home parks, or you might buy a 500 unit storage facility, which is for us 50,000 feet of storage, and then maybe 5 mobile home parks, or two 500 unit storage facilities. It doesn't matter really the product type. The whole point is if you're able to buy that many units and increase the rent, the NOI, I should say, by $8 a month per year for 5 years, that's how the math plays out. Now, you can also modify all of those assumptions. You can say, okay, I don't want to do 1,000. I don't, I can't even wrap my mind. Yeah, nice answer, nice try. I don't get it. I don't want to do it. Whatever that happens to, whatever you think on it. You might say, well, 100 units or 50 units, or you can modify that scenario to your liking and to your purpose any which way. Or you can say, hey, you know what? I want to do 100 units, and I think I can raise it $80. I can increase NOI $80 a month the first year. Well, that would have the same outcome that I just showed. So it's more or less, I was just trying to give you a framework for thinking about how you can start with a future outcome and back it into present action. And then, the last is, and I didn't say this, but if, there's a point where you look at that and you say, that's pretty compelling. If I were to buy 1,000 units, I would feel compelled to try to find a way to add $8 of NOI a year for 5 years to create $10 million of net worth. And last little comment on this, because I think it's also relevant. There's a story that I heard from a friend of mine, and I believe it to be true because my friend is a pretty significant individual. But there's a story he told me about Jeff Bezos, and this was a 10-year-old story, not recent. This happened years ago. There's a story about Jeff Bezos, I think in the mid 2000s, where he was going around taking all the light bulbs out of the vending machines and all the warehouses. And his methodology, his thought process was, number one, do you really need a light bulb to see what you're getting in the vending machine? You can probably see through. Number two, there's a cost of the bulb. Number three, the human labor required to go find the bulb, replace the bulb, that's all expense. And by removing the light bulbs, from what my friend said, he thought that they would save like almost $1 million a year in total cost by removing light bulbs from vending machines and warehouses for Amazon. And so you may think of this, okay, well, this guy's neurotic. No, he understands the value of a dollar. If let's say Amazon at the time was trading for, I'm making this up, but let's say at the time it was 30, let's say they had a 30 PE at the time, whatever time I'm talking about, then, Bezos, by removing the light bulbs, which saved $1 million, would have created about $30 million of shareholder value or equity sourced from saving bottom line growth, light bulbs, and vending machines. So there's all of this is producing a way of looking at the world, which then informs how you go about what it is you're doing, which we think might be helpful. So anyway, hopefully that's a sufficient answer.
That was a great answer. So I think this is going to be our last question. Again, guys, if you have questions after this, feel free to reach out to Ryan directly. But this is such a trendy topic right now. I love this question. What do you think about the tiny home communities that are popping up over the last couple of years, especially in markets like Austin, other places? What's your opinion on the tiny house movement?
Well, so two things. One, I think they're cool. I think they're neat. They're trendy. They're cool. I don't think it's any way competitive or it's not competitive in a competitive sense with mobile home parks. And the reason or the basis for my saying that is this. One, the average mobile home today, you can buy a mobile home for call it $30,000 plus or minus. It's about 1,000 square feet. So the cost to build it is about $30 a foot. A lot of the tiny homes, and I saw some data that says the average tiny home, ironically, is about $30,000. And it's about 400 or less feet. Okay, so when you look at the cost for the space, a lot of America today is not looking necessarily for trendy. They're looking for the most space they can get for the lowest cost, that intersection of space and cost, especially for a family that has one kid, two, three, four, or so. So mobile homes really serve a very specific niche that tiny homes really, in some way, maybe in small sections of crossover customers can compete with, but the middle of tiny homes is nowhere near the middle of mobile homes in terms of the customer it's serving. But that being said, I think tiny homes it's a cool concept. I think they're here to stay. It's going to be interesting to see how they take shape in the future with some of these modular construction systems like Blockable and others that are kind of emerging. But I don't see it as disrupting, the industry, so to speak.
Mm-hmm. Yes, that's a great point there. It kind of seems like a different bit of a clientele there between the two. So we are just about out of time tonight. We still have some questions pouring in, but guys, reach out to Ryan directly. We've got all of his contact information here. Ryan, before we sign off for the night, do you have any last kind of closing thoughts that you would like to leave our audience with for the night?
Yeah, I'd just say thank you, Haley, and thank you, Kurt and Quest, for doing this. There's always an excuse to do nothing, and you chose to put this together and invite these nice people out. So thanks for doing this. I certainly enjoyed it. I hope they did, and my hope is that you take the information and use it, and hopefully that'll add some value to your life in some way. And to the extent that I could ever be helpful, do reach out, and I look forward to get to know you and help you in any way I can.
Mm-hmm. Awesome, Ryan. Well, thank you so much. I have even personally enjoyed this presentation. I've been, watching it and really actually tuned in. So thank you so much for joining us tonight. I'm sure we will have you back on some of our webinars soon because I want to dive into some more of these topics with you as well. And to everyone out there, thank you so much for joining us. Be sure to watch the rest of our classes this week. Check out those resources that we put in the chat. And don't hesitate to reach out to either Quest or Ryan if you have any other questions, and we will be more than happy to help. That's all we've got for you guys. Y'all have a great night. We will see you in the rest of our classes this week. See you later.
Thank you.
Bye, Ryan. Thank you.